Hi everyone, welcome to the channel Fill in the Gaps. In today's video, I'm going to show you how to merge two companies' financial books together. Also, similar to a business consolidation. So the scenario here is that we have two companies, Company A and Company B. Company A is going to be the surviving entity, meaning that Company B's financial records are going to merge or consolidate into Company A. So only Company A survives, hence surviving entity, and Company B will no longer exist because it merged with Company A. So Company B, after the merger slash business consolidation, will not exist as a separate entity because it will become Company A. Hence, that's why it's called merging entity. It's merging into Company A, which is going to be the standalone surviving entity. And behind all the compliance and all the operational things that happens in real life, we will probably not go into that. However, for the purposes of accounting presentation, what we're going to do is the books of Company A will be consolidated to Company A. So to repeat that, the books of Company B will become Company A. And we'll just have a few assumptions right now. Let's assume these are the year-end 2022 numbers, and they operate at a calendar year-end. So it is as of December 31st, 2022. This here is the year-to-date balance sheet of Company B, as well as the year-to-date income statement figures. And our goal is to take all of Company B's financial records and merge it to Company A. And let's assume, because it's the year end for both companies, the effective date of the merger is January 1st, 2023. So it's the new day of the year, where the effective date where we put all these numbers, the year end numbers, into Company A will be put it in January 1st of 2023. So you ask, how do we do it? Well, because looking at Company B right now, since these are year-end numbers, so the numbers are good to go. And what we're going to do, if you recall, is that the income statement is mostly a annual to annual presentation or fiscal year to fiscal year presentation. So after the year ends, you close it out and you take the net income and put it into retained earnings. So then the next year, 2023, it'll be a fresh new start income statement with new activities for the new 2023 year. But because this Company B is no longer going to survive on its own, we are closing it down completely and officially so that there will no longer be income statements presentation for them. So how we're going to do that is that you're going to have to make a journal entry where you close out all the revenues and expense accounts of the income statement, and then you put it in the retained earnings bucket. So basically, zero out everything here. So For example, we have our cleaning revenue and participation revenue here, our realized gain and dividend income. So these are all the revenue items. And then you also have your expenses, wages, utility fee, investment expense, as well as tax expense, and you will close it out to retain earnings. So our entry will be debit, cleaning revenue, participation revenue, realized gains, dividend income, and then credit the expenses. So you're doing the opposite because you're taking it out of your income statement and closing it to retain earnings. Because if you recall, retained earnings is basically your accumulated net income or loss since the very beginning of time, since the inception of the business. I'll just double check if retained earnings should be a negative or a positive by taking the difference of these two here, your revenues versus your expenses. Okay, so it's going to be a credit. So now I have took the things out of the net income and put it into retained earnings. So now that we know, and note that retained earnings is a balance sheet item. The balance sheet will always be the total balances of your assets, liabilities, and equity. And then the income statement is stuff that you report annually, but towards the end of the fiscal year end, you close it out to retain earnings, which is a balance sheet item. So now that I close it out, these will be null. And if you think about it logically, during the year, all the revenues would have been a credit and all the expenses would have been a debit. But you're reversing it because you're taking it out of your profit and loss, your revenues and expenses, and closing it out to a balance sheet account, retained earnings. Because the retained earnings is the balance of everything. That doesn't change until each period there are changes in here. So the changes on your income statement each year towards the end of the year will update the balance of your retained earnings. Hopefully that makes sense. So this is a key number here because now, because it's closed out, we're going to assume that we're not going to have net income anymore because we've closed it out of P&L. So I'll times it by 0. And our retained earnings now goes up by the $12,956. So now our accounting equation is still fulfilled where total assets equals liabilities plus shareholders' equity. And our net income is closed out for the year. So that's step 1. is to close the P&L to retain earnings. And now we are ready to prepare the January 1st, 2023 consolidation merger entry. So I'll label it here. Company B merges with company A. So to merge the financials, basically what you have to do is that you combine the balance sheet of company B to company A. So basically, original company A plus the balance sheet year-end items of company B equals the new consolidated company A. Because you recall, company A is the surviving entity. So this journal entry was a company B's closing entry, but this entry here will be a company A entry because we are putting the information of company B into company A. Hopefully this makes sense. So here we go. With assets, at default, they are debit entries. So I'll just run it through like this, like so. Do debits, and then the debit balances of all of the company B's assets. So this will be a debit. Our liabilities are credits. So I'll take the liability accounts and do it as a credit. Our equity accounts are also credits. So we'll credit common stock and credit retained earnings to company A's books. And there's not going to be any net income because you're not factoring any P&L into company A. You're only taking the balances of everything and putting it to company A since we already closed P&L. So you could do a double check across a validation to make sure your debits equals your credits. Okay, so now this is going to be the merger entry. So obviously, if you were doing this in a accounting software, it would be a lot quicker. But for this educational purposes, I'm going to show you what will be the revised, updated company A balance sheet. So we know this was December 31st, 2022 numbers. And now we are reporting that information as of January 1st, 2023, but let's assume it's the month end. So January 31st, 2023. So our cash account will now go up by an additional 11,500. So now this will be the new balance. And then our money market will be what's currently in company A plus the merging entry. And then there is a mutual fund account asset that is being consolidated to company A, which company A doesn't used to have. So we're going to create a new asset line to factor that in. So then it used to be 0, but now we are consolidating a mutual fund account. And then we also have the cleaning supplies. And there's also furniture. And there's also equipment, which is also a new asset that is being consolidated to company A. So I will recognize that. So it doesn't had a balance because it never had equipment. So, but now we have equipment. Okay, let me fix the formatting. And this will be the new month-end asset balance. Now, moving on to the liabilities. Same thing, take what is currently in company A plus the new stuff that they're merging with company B. And that becomes the revised liabilities total. Now on to equity. Oh, there won't be any net income from company B. Then we also have retained earnings. But we need to know that since now it's the balance of company A, we can take on the net income from company A. So now I'm going to do another check here. And it says I'm off by $2,000. So let me double check what am I missing here. Okay, it is actually, let me see what I am missing. It is wages payable. I noticed that because it is a new liability account from company B that company A never had. Okay. Hopefully this will balance it out. All right, so now our assets equals our liabilities plus shareholders' equity. And there you have it. So we could hide this now. And this will become the new balance sheet of company A, who has consolidated company B's information. And then each month, whatever happens in company A's income statement will factor in what used to be company B's balances. It will be part of the ordinary operation of company A. Hope this video makes sense and was helpful. Thank you so much for watching. Have a great day, and please like, leave a comment, and subscribe for any type of other videos you'd like to watch. But I'll also have a lot of videos planned more on accounting and finance, so make sure you stay tuned. Thank you so much and have a wonderful day.